Bank profits are crashing as mortgage lending dries up and empty office space builds. I'm your host, Steven Van Metre, and thanks for joining me today in headlines that are going to dominate bank earnings over the next couple of quarters as their bread and butter lending dries up, threatening to crash profits. And as empty office space builds, a wave of defaults could be a big problem for the banks. Let's head over to the Wall Street Journal where we picked this story up as mortgage refi boom is running out as lenders issued only $859 billion in mortgages in the first quarter, down a whopping 25% from a year ago. The main cause was a sizable drop in refinancings, which fell about 40% from a year ago. Purchase mortgages were roughly flat, a turnaround from 2 years of double-digit gains. And the mortgage slowdown is yet another example of how rising interest rates are playing out in every corner of the economy. The Federal Reserve has raised interest rates twice already this year in a bid to tamp down the highest inflation in decades, pushing up borrowing costs across the board. It has also pushed up the yield on 10-year Treasury, which is closely tied to mortgage rates. And this is exactly what the Fed wants to do. They're trying to pull back the reins on demand. They want to slow credit growth. They want to slow the economy down. And we see what higher interest rates do. There's a lack of demand. And this is how we know that there's going to be a reversal in rates, because as demand goes down, as rates rise, well, then rates must fall. But so far, the Fed is successful at what they're trying to do. And keep in mind, there's more of the Fed coming next month. Higher mortgage rates can add hundreds of dollars to households' monthly mortgage payments and have forced some would-be homebuyers to give up. A faster-than-expected rise in mortgage rates has also accelerated the decline in refinancing, the juggernaut that drove mortgage originations and industry profit to record levels in 2020 and 2021. And refinancings are expected to make up 33% of mortgage originations in 2022, down 59% in 2021. And now you can see already the bank profits are going to come crashing down right alongside refinancings. And mortgage rates jumps about 1.5 points in the first quarter and have continued to rise since then. Last week, the average rate on a 30-year fixed mortgage hit 5.27%, its highest level in nearly 13 years. And higher interest rates shrink the pool of borrowers who could lower their monthly payments by refinancing. That group fell below 4 million in March, down from about 18 million in March of 2021. And this is something I've talked about, that as rates go up, people have no desire to refinance at them. And all of a sudden, as the pool of borrowers falls, well, the banks then must drive rates back down to again find new borrowers, because this is where they make a ton of money on. They don't make as much money on credit cards or other things, but refinances is big money for banks and a big profit center. The combination of higher rates plus continually rising home prices has pushed monthly mortgage payments to the least affordable level since 2008, according to the Federal Reserve Bank of Atlanta. The median American household needed 34.9% of its income to cover payments on a median priced home in February, up from 29.2% a year ago. Americans who can afford to stay on the market are trying to take the sting out of rising mortgage rates by paying upfront fees to reduce their rate or lock in a lower rate, something they don't really need to do, because history shows that rates are going to come down right alongside bank profits. Americans took out about $177 billion in auto loans the first quarter, a 16% increase from the first 3 months of 2021. And much of that jump reflects an increase in car prices rather than an increase in the number of loans issued, according to the New York Fed. Auto originations declined about $4 billion from the fourth quarter. And so what we're also seeing is consumers take on a ton of debt. During the pandemic, people paid down their debt, and now they have even more. And from a bank's perspective, when you have this tidal wave of originations, and then you have people unable to afford new mortgages, new loans, well, that has a direct impact on your bottom line. And here we can see the refinance is something we look at every week, is we can see low points in the refinancing index, and currently we're not at the lowest level but in a long time, but we're pretty close to it. And we can see 2014, 2017, 2019, and here in 2022. And what does that mean for yields? Well, we look at here 2014, we see a peak in yields and they went down. We see around 2017 they got high and they went down a little bit. 2019 they peaked and went down. And here in 2022, the consensus view is rates are only going up, but based on what's going on in the refinance finance world, well, and bank profits, it tells you rates are likely to come down. And this is a time when office space is building, threatening defaults at some point if this space isn't rented out. And this could be a big problem for banks in the future. Back to the Wall Street Journal, who headlines the office building owners drown in a tide of sublease space as office space is hitting the market as landlords grapple with low demand and lease expirations. The amount of space listed for sublease surged the first year of the pandemic to the highest level in decades in some cities, but it fell in the second half of 2021 as offices leased up and some companies took listings off the market. Now it's rising again as sublease availability across the U.S. increased 3.6% in the first quarter to 159 million square feet. That's still below last year's peak of 162 million square feet, but well above pre-pandemic levels. And that is a huge problem because, as you know, many people are running either hybrid work options or working from home. And all that space is hitting the market at a time when landlords are already grappling with low demand and a record amount of lease expirations, pushing rents down and vacancies up. There's just not enough tenants who will absorb these spaces. The recent uptick in companies putting their space on the market is a delayed response to the Omicron outbreak of late 2021, which led to more companies to settle on hybrid work and cut space. It also reflects uncertainty over the global economy amid inflation. And of course, if this space isn't eventually rented out, then the landlords face potential delinquencies and eventual default and handing that back to the banks, something they don't want. And many employees work remotely or only come in on some days, meaning the office is only about 20% occupied. By cutting space, the company is looking to lower its real estate bill. Every dollar is important to a company, according to the experts. And this is something that's important because with banks lending crashes, well, rates crash and the economy goes with it. Because we have to understand that a new deposit in the banking system is created when a new loan is originated. So if there's not a lot of new lending going on, well, the money supply growth slows, the economy slows, and likely tips over into recession. And this is already coming after a negative first quarter. But if you're concerned of what a debt bubble could mean to your portfolio, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link up here in the corner and the description below, because now we're seeing the impact on higher prices hit consumers even more, indicating that once they get tired of borrowing money and realize they need to pay it all back, well, that means even less spending is going to hit the economy. As prices in the U.S. outstrip forecasts and a sign of inflation persisting, headlined by Bloomberg as core consumer price index rose 0.6%, exceeding a 0.4% estimate as the April CPI was driven by airfares, new vehicles, food, and shelter. And U.S. consumer prices rose by more than forecast in April, indicating inflation will persist at elevated levels for longer and keeping the Federal Reserve on the path of aggressive interest rate hikes. And that's really the key to this whole inflation story, is what it means to the Fed. And as long as the Fed is on a path to tightening, that means they're going to continue to pull liquidity out of the market, as we talked about yesterday, and that will have a direct impact on stock prices. And of course, if you want to kill inflation, one of the fastest ways to do it is drive the economy into recession. And if you can avoid that successfully, which is the Fed's trying to do, if you can just bring the stock market down, as we talked about yesterday, it'll bring inflation down with it. The core consumer price index, which excludes food and energy, increased 0.6% from a month earlier and 6.2% from April 2021, according to the Labor Department. The broader CPI rose a mere 0.3% from the prior month and slowed to 8.3% on an annual basis, still one of the highest readings in decades. Fed Chair Jerome Powell signaled last week that officials are open to several half-point increases in the central bank's benchmark rate in the months ahead. The CPI will help shape estimates for April personal consumption expenditures price index, the Fed's preferred gauge of inflation. It's important to understand that Fed Chair Powell said that one low report on the CPI is not going to do it for him, and this one certainly is one that's going to tell him continue to hike and continue to be aggressive. And part of that hardship stems from the fact that inflation continues to erode even rapid wage gains. Adjusting for inflation, average hourly earnings fell 2.6% in April from a year earlier, marking this 13th straight decline. And so what we see in this chart is that consumers, while they're getting wage increases, their average weekly hourly earnings when adjusted for inflation are negative. And this is what's interesting, because many people believe that consumers can continue to drive the economy, but what the Fed's trying to do, as we talked about, is pull back demand. And if you have less money to spend, despite wage increases, well, that's a quick way to pull back demand. And when growth and inflation expectations fall as demand falls, it's bearish for stocks. and bullish for bonds. And what we can see now is there's one month now coming between the next Fed meeting, and that means one more CPI print between now and June 14 and 15, when the Fed's set to meet next. And of course, with today's CPI print, well, even if next month is slower, it still means we're on the pace for a 50 basis point hike on top of quantitative tightening. And if you think the stock market can handle that, if you think bank profits can get through it, well, I think it'll be in a surprise, because banks are in trouble and it's only the beginning. I'm your host, Steve Van Metre. Thanks for joining me today. Thanks for being a fan. Bye now.